Hello guys, my name's Luke and welcome back to part 2 of this video series where we're analysing the huge bubbles in the housing and the stock market. Now here in part 2 we're going to be analysing why the very same chart of the stock market looks so different when you price it in two different forms of money. Because when you price the stock market in fiat currency or dollars, the stock market looks to have appreciated somewhere between 5 and 600% over the previous 20 years, making it a great investment. But when you price that very same stock market index in a form of money that is not having its supply artificially manipulated, which is gold, you can see that that very same stock market index is not up 5 to 600%, ladies and gentlemen. It is actually in the red over those same 20 years. Now, in today's video, we're going to be analysing what and how that is even possible. And we're going to be following on from many of the very important macro fundamentals that we covered in part 1 of this video series. So if you haven't seen part 1, go and check it out. I'll pop it up on screen at the moment because it's very important in trying to understand whether central bankers and the big governments will be successful in reinflating these massive housing market and stock market bubbles that are currently built on the $300 trillion of worldwide debt out there. And even if they are able to reinflate these bubbles, what is it going to do to the purchasing power of the very money that you hold? But let's get into part 2. Okay guys, so here we're looking at a chart of the S&P 500, which is the largest 500 companies in America. So as you can see, we're looking at about a 30-year chart, and ever since the year 2001, after the tech stock bubble crashed, we can see that the S&P 500 has actually gained around 350%. We got 390% here, guys. So that means it's nearly 5x. So if you were to put $1,000 into the S&P 500 back here in the beginning of around 2001, 2002, that $1,000 investment would now be worth around nearly $4,800. So as we touched on in the intro, that looks like a great investment, doesn't it, guys? I mean, the stock market looks to have done really well over the previous 20 or 30 years. But now we're going to look at the S&P 500. This is the exact same stock market index, but all we're doing is we're going to price it in gold, a different form of money. Now, for regular viewers, you guys would know that gold has been money for the previous 7,000 years for very good reason. Because every time we use a fiat currency, it fails when governments print too much of it. But we're going to touch on that one a little bit later. So as you can see, guys, ever since the year around 2001, we got the same time period. This is a 30-year chart of the S&P 500. And as you can see, stock markets, when you price it in gold, they're not up 400%. They're down 45%, guys. That is because gold isn't doing anything magical. The governments just can't manipulate its supply. But with the dollars that they need to print to keep the Ponzi scheme and to keep the $300 trillion debt bomb from exploding and collapsing, governments have to devalue their currency and funnel it into the stock market so that we don't have a massive deflationary spiral. But we're going to touch on that one in the second part of the video after we have a look at some more stock markets, like the European 50 stock market and also the British pound stock market, because this isn't just in America where the stock market's priced in dollars look as if they're doing great. This is a global phenomenon, guys. This has all got to do with every country around the world using a fiat currency. Now, the reason we're deciding to look at the previous 20 or 30 years is because that is when all the money supply has exploded. As you can see here, guys, this is a little chart of the global money supply dating back to 1971. And regular listeners would know that is the year that that initiated this financial experiment. In 1971, it was the first time in 7,000 years of monetary history that every every single currency around the world was taken away from a gold backing, meaning the currency, whether it's Australian dollars, Brazilian real, the US dollar, they were all backed by nothing, giving governments and central banks the ability to print them out of thin air and create these massive bubbles that we see in the stock market and the housing market, guys. Okay. So when we have a look at the money supply, as you can see, the closer a fiat currency gets to collapsing, which, if you're a regular viewer, you know every single time a fiat currency has been used, it has collapsed when governments and central banks print too much of it to enrich themselves, okay, by blowing up these huge bubbles. So as you can see, the reason we're looking at the stock market the previous 20 years is because this is where the money supply has exploded. The closer that currency gets to collapsing, the more money and the more debt it needs to get that same amount of economic growth or economic activity, guys. That's why you're seeing this year in America, oh, not America, worldwide, central banks around the world have printed more money this year than the previous 200 years in monetary history combined. Okay, this is just how a fiat currency collapses, and because most of us in the developed world have not seen that, so that's America, Australia, New Zealand, we haven't seen a fiat currency collapse, so we don't know what we're looking for. Okay, so it's going to catch a lot of people off guard. But so now we're going to go and have a look at the European stock market and also the British pound stock market, because they too look very different when you price the stock markets in a different form of money that is not the fiat currency, when you price it in gold. Okay, guys, gold isn't doing anything. It's remaining stable. All gold is doing is just showing you the devaluation and the devaluation in the purchasing power of the fiat currency that's being used. Okay, when we have a look at a more recent example of a fiat currency that collapsed, this is the Zimbabwean stock market. As you can see, the stock market done absolutely amazing for the very top 1% of people who owned all their life savings in the stock market. They done great, but the 99% of people who can't get their hands on many shares in the stock market, they were absolutely impoverished as that currency collapsed. As you can see here, guys, starving billionaires. Okay, guys. So when we look at the stock market, it's exploded. It's very common sight of a currency that is failing, and that is what I believe we're watching around the world this year. Not just isolated examples in Zimbabwe or Venezuela or Argentina. This is a worldwide phenomenon. Okay, every country is printing money in order to deal with historic levels of debt. But now we're going to have a look at the European stock market and also the British stock market, and then in the next part of the video, we might have a look at where all this money is going a little bit closer, because as you can see, the global money supply, as it raises, as it goes up, so do stock markets. And we're going to be looking the exact mechanisms of how that freshly printed money ends up into the stock markets and essentially ends up into the pockets of the 1%. And it gets there by robbing the 99% silently through inflation. That's right, guys. That's the price of your groceries exploding. But now let's get on to those other charts. Okay, confusing, I know. But when you price, let's look at stock markets when you price them in gold. So this is the FTSE 100. This is the UK's largest 100 stocks. As you can see, since 2000, and when the central banks have been printing money out of thin air, stock markets have actually not just not back at their all-time highs, but they look absolutely dismal when you price them in gold, which is real money, a money that you can't increase the money supply. So let's have a look at the same graph. So the UK 100, this is the FTSE. Let's have a look when you price it in dollars and why it looks so different when you price it in gold. So we're looking over here on this other graph. We're looking at the FTSE 100, and as you can see, the graphs look very different, don't they, guys? See here, stocks peaked in 2000, and they've never recovered, okay? But when we go and have a look at the FTSE priced in dollars,
it looks a little bit different, doesn't it? It's still going up when you price it in dollars. And when we're looking at it priced in gold, this was the peak that it never recovered to. Not even close to. It was down here somewhere, wasn't it? But when you price it in the devalued dollars, you can see it continues increasing because stocks are kind of acting as a safe haven. They're not, they're not, but they're acting similar to one because people know that dollars they're holding are being devalued. Okay, so let's have a look at another chart. So that was the UK 100. Let's have a look at the euro, the exact same story. Okay, when you price it in gold, the stock markets actually haven't made a new high since the 2000 bubble because that's when all the global liquidity injections began to occur. Now we're looking at the largest 100 stocks in the eurozone, guys. And again, same story as the UK stock market. When you price it in gold, hasn't recovered since its 2000-year high, all due to the global liquidity injections. It's the same as the Venezuelan stock market. I mean, it's the Venezuelan stock market was the best performing market of the previous 5 years, but that was because you're measuring it in devalued, hyperinflated dollars. I believe we're starting to see a very similar thing in all currencies around the world. Okay, so this is the Venezuelan stock market. And as you can see, whenever it goes through a hyperinflation, the stock market is the best performing in the world when you're measuring it in the devalued, diluted, worthless paper, okay? When you value it in the worthless paper, the nominal value can make it look like it's at an all-time high record value. But it doesn't matter. You could sell your stock, go and buy something real or tangible like some food, and you can't even buy any food with it, okay? Because you're measuring it in the wrong thing. You need to measure these stock markets against a form of money that's not changing. So it gives you a true representation of what's actually occurring to the stock market. So that's why we price it in gold, because gold doesn't change, okay? There's nothing special about gold. It is just a rock. It just sits there. It's just stable. So when you price in stocks, in devalued dollars, of course they're going to be at all-time highs all around the world because you're also increasing the money base exponentially in that same time, okay? But that is the game, guys.
Yes, that is the game, guys. As I said in a previously recorded video, sorry about the poor sound quality on that one. That was before I upgraded my mic. We are now rolling with the old Blue Yeti. If you enjoyed the higher quality sound content, hit the like button or hit the subscribe button. Help us out. I'm just trying to put out the best quality content for you guys here on YouTube. But main takeaways from today's video: it's not how many dollars you have that determines how rich and wealthy you are, okay, guys? It's how many goods and services that those dollars can buy you in the everyday economy. Remember, we looked at the charts of we looked at the charts of the S&P 500 priced in gold and also priced in the devalued dollars, and they look very different when you price the very same stock market in a form of money that is not changing, which was gold, okay? It's all about the purchasing power of the dollars that you have. And as you've probably felt in the previous 20 years, as central banks have printed more than $30 trillion in bailing out the banks and the financial system, the purchasing powers of the dollars in the bank have probably significantly decreased, guys. Anybody notice the price of groceries slowly creeping up 10% per year, hoping that you didn't notice the difference? Anybody remember what a Big Mac used to cost 20 years ago, guys? Well, look up that one for yourself. I can tell you, it was less than $1. Try to buy one today, it's over $8. But central banks claim that inflation is less than 2% per year, which gives them the ability to print money out of thin air, saying, oh no, look, there's no inflation here. Absolutely absurd, guys, but we're going to look into that one in the next video. We're also going to be touching on the one you guys have probably all been waiting for, and that is the housing market bubble. We're going to be touching on that one. But main takeaway from today's video, it's not how many dollars you hold, it's the purchasing power of the dollars. That really matters. The rich understand how this inflationary monetary policy works. They understand that it's criminal to hold your savings in cash because they're buying that the cash is buying you 10% less every year, guys. Okay, the rich know that's why, and the rich have access to get these loans, these huge loans at near 0% interest rate, and go and buy 10 or 20 houses in their housing portfolio, or go and leverage up their stock portfolio, because they understand that this is an asset bubble, and they understand that holding cash is a criminal offense, as as the cash is being devalued. Sorry, guys. Someone else who understands how quickly that cash is being devalued, and that's Michael Saylor, CEO of a massive NASDAQ-listed tech company, guys, MicroStrategy, which broke the internet 3 weeks ago when Michael Saylor came out and said, hey, look, we don't want to hold $250 million worth of cash. It's being devalued at 10% per year. His very words was that he didn't want to hold a form of money that was being devalued, so he went and just bought 20,000 Bitcoins. Just a lazy $250 million investment. Oh, and guess what? Michael wasn't done. The small Bitcoin dip last week, he said, hey, look, we're going to go balls deep. We're buying another $170 million worth of Bitcoin because we don't want to hold the devalued cash. But I'm putting out another video on that one possibly today, maybe tomorrow, so keep an eye out for that one, as we'll be taking a look at the other 3,500 companies in the world that are larger than Michael's, and what are they going to do? Are they going to follow his lead? What's that going to do to the Bitcoin price, guys? We'll be checking that one out in the following video, but that is all for part 2 today, where we analyze these huge bubbles in the stock market and just the zombie state of this so-called financial system, because it's all about to change, guys. This is why I've created my YouTube channel at this particular time. I believe that the whole financial system is changing right now. To implement such a large change in the financial system, you also need a very large excuse to do so, don't you guys? Look around the world. If you're going to change the global financial system, you're going to explain to every single person in every single country around the world why their local currency is hyperinflating. Now, look, guys, this isn't just an American problem or an Australian dollar problem. This is a problem in every currency around the world. And as you can see by this chart, as their local currency dies, they are adopting Bitcoin. Look at it surging in 2020. Now, if you're going to implement a new financial system, which happens every 50 to 100 years, guys, when the debt becomes unsustainable, you need a new financial system, okay? Every single time, guys, that a global reserve currency or just a local country has had a debt to GDP ratio greater than 130%, that country has defaulted on that debt. And that is where the United States is right now. Our global reserve status, and every single local country is pegged to the United States. So when they default, we also default. And I believe, as you're going to see in the following videos, the way they're going to default on that debt is continually devaluing their dollars by printing it into oblivion. They've created more money this year than the previous 200 years combined, guys. That is the game. It's the end of fiat currency. But that'll do us for today. I've been rambling again. I'm sorry about that. Check us out in the next videos. Thanks again, guys. If you've learned anything, you know the drill. Help us out. Hit the like button. Hit the subscribe button. Stay tuned for future videos. See ya.